Every single day, Wall Street just unleashes this fire hose of news, numbers, and noise, right? It can feel absolutely impossible to figure out what actually matters. So we're going to cut through all of that. This is your guide to the key signals that really move the market today. Let's get into it. Here's how we're going to break it all down. We'll start with the positive stuff, then get into the negative signals. After that, we'll cover the big corporate shakeups and Wall Street's mixed reviews, before we wrap it all up with the big picture takeaway. All right, first up, let's talk about the good news. We're going to spotlight the companies that are showing some real signs of strength and building some serious confidence in the market. We have to start with SoFi. When a CEO puts $500,000 of their own money into company stock, people pay attention. This is not some routine transaction. It's a huge statement from the ultimate insider. And here's why that is such a big deal. Insider buying, especially from the CEO, is one of the most powerful bullish signals you can get. Think about it. An analyst is on the outside looking in, but the CEO, they see the whole picture. A purchase like this basically screams, I believe our stock is undervalued and good things are coming. It's the ultimate put your money where your mouth is moment. Okay, so let's switch gears from that kind of insider confidence to broader market confidence. While the SoFi CEO was buying, investors were absolutely piling into another fintech player, Lending Club, sending its stock up over 12%, a huge move. You know what's really interesting here? The timing. This jump didn't happen right on earnings day. It happened 2 days later. This just goes to show you that the market is still processing the company's fantastic third quarter results, where they totally blew past expectations. It's a delayed reaction for sure, but a very powerful reward for great performance. And this positive vibe wasn't just a one-off thing. We saw this theme of growth all over the place. Affirm is still riding the wave from its WorldPay partnership. Block is innovating with AI-powered savings to get users more engaged. Robinhood is pushing its crypto business in Europe, and even Offerpad saw a big jump on the simple hope of lower interest rates. It's a really clear picture of growth coming from smart deals, new tech, and just plain old good economic news. But of course, it wasn't all sunshine and roses. Now we have to pivot to the other side of the coin, the companies that are facing some serious pressure and a whole lot of doubt. This slide lays out a major theme perfectly: rising regulatory risk. On one side, you've got PayPal getting looked at in Europe for potential antitrust stuff. And on the other, you have Coinbase stock dropping 6% here in the US because the SEC's turning up the heat. Two different companies, two different continents, same exact headache. It's a pretty clear sign that regulators all over the world are starting to take a much harder look at fintech and crypto. Now let's talk CarMax. This is a classic cause and effect story. It all started about a month ago with a really bad earnings report. The stock, of course, took an immediate nosedive. And now? Well, now the law firms are starting to circle, looking into whether the company might have misled investors. This timeline just shows you how fast one bad quarter can snowball into a massive legal problem. And hey, sometimes the pressure comes directly from Wall Street itself. Upstart fell 4% today for a simple reason. Morgan Stanley repeated its skeptical underweight rating. That's basically the bank telling its clients they expect the stock to do worse than the rest of the market. It's just a powerful reminder of how much sway these big bank ratings really have. Okay, next up is the drama section. Let's dig into the deals, the departures, and the major moves that could totally reshape the future for some pretty big companies. The big M&A news of the day is coming out of the pharma world. Eli Lilly is buying Adverum Biotechnologies. But the really interesting part of this deal isn't just the acquisition. It's how they're structuring the payout. And that brings us to this key term, the contingent value right, or CVR. Honestly, just think of it as a bonus. Adverum shareholders get their cash for the deal now, but they also get the CVR, which is basically a promise of more money, up to an extra $8.91 per share if Adverum's main drug hits certain goals down the line. It's a pretty clever way for the seller to get a piece of the future upside. Over at Teladoc, we've got a classic head-scratcher. So on one hand, their CFO is leaving, a move that almost always makes investors a little jumpy. But at the exact same time, the company pre-announces that their third quarter results were actually better than expected. So which signal do you follow? The top executive heading for the door or the strong financial numbers? It's a real puzzle. And finally, you have to see this report from Bloomberg. It's a big one. When a company like Warner Bros. Discovery, which has been in the sale rumor mill for a while, reportedly starts opening its books to potential buyers, well, that means things are getting serious. This is a huge step that suggests a potential sale of the media giant could actually happen. That brings us to our next section, where the news isn't just good or bad. These are those complex, kind of messy situations where even the Wall Street analysts can't seem to agree on what's going on. Let's just look at Deckers, the company behind UGG and Hoka. As you can see right here, they beat expectations on earnings and on revenue. A clear home run, right? Well, not so fast. Look at the analyst reaction. While some firms were like, great job, and raised their price targets, others, like Truist, actually lowered theirs because they're worried about future growth. So you have a great quarter, but a totally divided verdict from Wall Street. And what about Netflix? The stock's been under a lot of pressure after what the market saw as an earnings miss, meaning, it just didn't live up to the hype. That negative performance is obvious. But then you have a really high-profile, influential investor like Cathie Wood in ARK Invest jumping in and aggressively buying the stock while it's down. This is the classic battle between what's happening right now versus a big bet on the future. Here's another fascinating conflict. Duolingo's big story is all about its advanced AI strategy. That's the long-term vision. But Bank of America, they're focused on the short term, and they cut their price target because recent data makes them nervous that user trends might be slowing down. It's a total tug-of-war between the company's exciting story and the cold, hard numbers of today. So, after looking at all these individual stories, what's the big picture? What were the main forces that were really driving the market story today? 3 themes really jumped out today. First, it was this battle between confidence and caution. You had powerful insider buying going up against these intensifying regulatory probes. Second, the M&A engine is definitely running. Confirmed deals are creating opportunities, and those big, rumored sales are creating a lot of uncertainty. And finally, you have to look beyond the headlines. As we saw with Deckers, a great earnings report doesn't always mean you're going to win over Wall Street. And that really leaves us with the big question, right? Of all these different signals we saw today, insider confidence, regulatory pressure, M&A chatter, which one is going to be the one that echoes the loudest tomorrow? That is the story to watch.